Our third Squawk Market Master of the morning out with a new piece on changes in the investment landscape. Joining us right now is Bill Gross, the founder and co-chief investment officer of PIMCO. And Bill, you've been concerning a lot of people who watch you and look to you for any signs of what we should be looking out for. I have a question for you.
Sure.
Do you watch Walking Dead?
No, no zombies for me.
I wondered because Joe and I are addicted, and I was wondering if you'd been watching the same thing, if that's why you're worried, because you're looking for serious, drastic, scary changes out there. What made you get to that point where you're looking for those kind of changes?
Well, nothing in the immediate future, Becky, I suppose, and that's important. But, you know, over several years or longer-term basis, I'm looking for changes in the credit markets. You know, we've seen an expansion since 1970 when Nixon went off the gold standard from $3 trillion worth of credit to basically $56 trillion now in terms of a market. And, you know, it's a fair question to ask whether that credit can keep on expanding, you know, at 0% interest rates, whether or not the magic elixir of real interest rates that we had in the 70s, 80s, 90s, and even, you know, up until the last 5 years will produce the same magical results as they have in the past.
What changed your mind the most, though? Is it what we've seen from central banks?
Well, I think so. You know, that and, of course, 2008 and the fact that the U.S. economy and the global economy, you know, hasn't significantly delevered. We're still at 350% of GDP here in the United States, and that's a significantly high compared to the 1930s in terms of leverage. And unless we ultimately delever, you know, that particular metric, then an economy is in difficulty in terms of expanding.
Bill, the stock market in recent years has been it's been at the advantage for all the trouble that we've seen with what's been happening with bonds. People have looked at that and thought, wow, this is the best place to be putting your money. But you're talking an event that would not only take down the bond market, but also stocks?
Well, we're not necessarily talking about an event here, Becky. We're talking about a slow drag, I suppose. You know, we've talked about the new normal. That's Muhammad's phrase. Yeah, basically, we've seen that in terms of real economic growth, although it's been much better in terms of stocks. What we're talking about going forward is a situation, at least in the equity market, where earnings, and not earnings per share, but earnings, you know, slow down significantly because interest rates have basically bottomed, and that's been about 40% of the decline, you know, that we've experienced in interest rates and an upward push in terms of earnings for stocks going forward. Also, unit labor costs have seemed to have bottomed as well. So we're going to see earnings per share go up as companies buy their stock back. But other than that, you know, earnings seem to be flat. We'll hear more this afternoon, of course, from Alcoa.
Hey, Bill, Brian Belsky from BMO. Let's implement some of this now. So if you're just looking very simply with respect to stocks versus bonds, and you're speaking with mom and pop in Lincoln, Nebraska, or mom and pop in West Lafayette, Indiana, what should their stock versus bond allocation be today? What should it be 10 years from now? And what are the implications in between?
Well, it depends on their age, of course, as you know. And to the extent that boomers are aging, you know, a typical boomer being 57, 58, 59 years old, then obviously they have to look towards more fixed income and less risky assets. That's just an unfortunate process in terms of demographic aging. You know, we would suggest, however, that stocks are the better deal. Stocks are a 4 to 5 to 6% returner to our way of thinking versus bonds at 3 to 4. And so stocks will outperform bonds, but ultimately the aging demographic will force more and more individuals in retirement plans into bonds.
You know, a lot of this stuff is longer term, much longer term planning. But, Bill, if I can ask you to focus just on the immediate. On Friday, we got those terrible jobs numbers, gains of just 88,000. And then we watched what happened to the 10-year. It got pushed, the yield, back below 1.7%. So if you're looking at short time, in the very near future for these things, how does this all add up? Yeah,
we see a 3% GDP quarter in the first quarter, Becky, slower for the next 9 months. You know, financial markets are really feasting on an anticipated monthly gulp of Japanese flavored Red Bull. We've had a $75 billion program here every 30 days that's in effect the largest. This is the largest relative quantitative easing program ever, an amount equal nearly to the Fed's in an economy 1/4 the size. And, we don't necessarily endorse this product, this Red Bull product, but we recognize its ability to energize financial markets, and that's what's happened with stocks. That's what's happening with a declining yen. That's what's happening over in Europe today. And so monetary Red Bull can feel good for a while. Doesn't have many calories, but in fact, it has some negative consequences down the road if it sets the currency markets and interest rates and stock prices moving too quickly.
Bill, this is Barry Knapp from Barclays. When you think about those costs, is it inflation? Is it the reach for yield that Stein talked about, the so-called asset inflation? Or is it, creative destruction and you're keeping companies alive that wouldn't come alive or wouldn't survive otherwise, and then, you don't get the same capital formation, capital investment? And how do you think those risks of all this really aggressive central bank policy are likely to manifest themselves?
Right. I think there's a zombie element to that, which you just mentioned and which Joe and Becky have been talking about over the last hour or so. I also think that 0% interest rates have a very negative aspect in terms of earnings and business modeling. When you look at a bank in terms of net interest margins, they borrow at the same yield, basically at 25 basis points, but they can only lend at, perhaps 2 to 2.5% as opposed to 4 to 4.5%. And so their net interest margins are narrowed. Same thing with insurance companies, same thing with pension funds. Any company that deals in financial assets basically are seeing their NIMs, their net interest margins narrowed, and that's not good for business formation going forward. Banks, in effect, lay off employees, they close branches, et cetera, and you see some negative real economic growth based on that.
Bill, I know you said you don't like the Japanese Red Bill version, that you don't think it's good over the long haul. What about what the Fed's doing here?
Well, the Fed the same way. It's difficult to see exactly how they get out of this particular pickle. They've talked about tapering, and they're sort of giving the signal that at some point they'll have to, Becky. But, if the Fed continues to buy $1 trillion a year, that expands their balance sheet by 4 to 5% of GDP every year. And at some point they're going to own, along with other central banks, China and the like, a goodly portion, perhaps 60 to 70% of the Treasury market. That, in effect, eliminates the technical aspects and the liquidity of Treasuries and other, bond markets, and ultimately, I suppose, in stocks as well. And so the Fed knows that it can't keep doing what it's doing, and we wonder what happens when they stop.
Okay. Bill, thank you, and we will talk to you again soon.
Thank you, Becky.